Real Estate Jerky Live. I'm also the radio show host for Real Estate Jerky, and this is the extension of the radio show where we find that we really can't go super deep with our clients our guests, I should say, that we have on. And so we have them come on the following Tuesday on here and tell more about that subject we talked about. And last weekend was 1031 exchanges, and we have Jeff Yonamine, who is the expert in that. How you doing, Jeff?
Great. How you doing today, Ed? Thank you for having me on again.
No, it's our pleasure. Thank you so much. We really appreciate it because this is a subject that what happened was I got a call from a client, or I guess really not a client. I'm just used to saying that word, but from the radio show. He was listening to the radio show, and he was talking about how he was going to sell all his properties because he didn't want to deal with what's going on with the rental market and the fact that he, with COVID came through and he couldn't get certain people's out, and then now with all the new different laws that are changing in California, he's like, I'm just done. I want to get rid of them all. And I was like, that's really sad that person's like that, but there's got to be something else they can do with that to put that money in other things. And that was one of the reasons I wanted you on the radio show, was to talk about those other investment avenues. But first, let's talk about what is a 1031 exchange and why would you want to use one?
Sure. Basically, a 1031 exchange is a transaction where the real estate investor can sell their property and buy another like-kind property, which like-kind means anything and everything except your primary residence, and all different types of categories as far as real estate, commercial, residential, apartments, but it has to be held for investment. Anywhere in the United States, that they could defer their paying their capital gains tax by buying equal to or more in value. So that's why they don't have to pay the taxes, sell the property. They can basically sell it, defer it by buying other investments. This is one of the last tax shelters available to real estate investors, right? To help them create more wealth for themselves and eventually what? Give it to their heirs. So then they get a step up in basis and then you help them move forward in their lives. So this is one of the strategies that a lot of people do. And what we say in the industry is always exchange, exchange, exchange. And then when you die, you pass it on to your heirs and they get it as a step up in basis.
Right. And I was explaining some of this, this 1031 exchange, deferred exchange to a person who really didn't own real estate yet, right? They didn't even buy their first property. And they're like, why is this so important? Why is this, this way? I'm like, it's here, I'll explain to you, like you guys deal with stocks. A lot of people have Robinhood accounts right now and they're buying stocks and then selling the stock and whatever. Then now they're actually having to pay income tax on that because that is just short-term hold. If you had it, right? But if you had that in your investment account for retirement, 401k, 403b, IRA, when they would do that kind of thing, it wouldn't be taxed at that. They could keep that gain in there and keep growing it. And that's the same thing we're talking about now is if I have another house, if I have a rental or so basically before I get further in, I'm going to throw this on the screen, what for like kind. So if I have a rental right now, a single family home, that's a rental, I'm going to sell it. And instead of paying say that I bought it for $100,000, I'm going to sell it for $400,000. So there's a $300,000 gain on that. Normally I have to pay capital gains on that and give part of that money to the government, and I only have a portion of it to invest into my next endeavor. Correct. But with the 1031 exchange, this type of thing, we can actually take that full 300,000, reinvest it, and grow our portfolio even greater. We don't have to do it. So is that kind of summing it up the easy way to explain it to somebody?
Exactly. And basically what you're using is what? Tax money that you would have had to pay, right, to go reinvest for yourself. And so you don't have to, how would you say, invest everything. You could do a partial exchange, take some of the cash out, but just pay the taxes on it, right? And then parlay the rest into the new property. So the IRS is always looking for value to value. So if you sell for 400, you want to buy 400 or more to do a fully tax deferred exchange. If you go down a little bit to 300, then you just pay the difference, right? Between the 400 and the 300, you just pay the taxes on the 100,000. But the other way to do it is you're more familiar and comfortable with smaller properties. Then if it goes up to 400, then you sell it, you can split it up and buy two properties. Now you have two properties instead of one, and you just increased, right? your cash flow, because now you got two properties generating cash flow instead of one property generating cash flow. Now you have two properties that also go up in value, and that helps you increase your wealth.
Right, and this is so you can pass it on to your. This is generational wealth we're talking about. So we're talking about
Yes,
if you have real estate and you're acquiring it and you're growing it. It's a way to pass it on to your heirs and not have to worry about them paying capital gains or certain things when they receive it, because it's the step up basis. And I don't want to jump ahead too far, but basically this is a great situation to use this product so you can grow more real estate, more property, so that you can grow your wealth.
correct. So what happens when you start beginning to invest in real estate, right? You buy one, then you sell it, then you split it and you buy two, right? And then you sell those and you split it and you buy four. And then what happens? You're accumulating your wealth. Once you get to the top of your wealth area that you want to be at, then you start deciding, okay, well, how am I going to then structure this for my heirs, right? So then you start putting it into your trust, get your estate planning attorney to make sure you do all that. And so you start designating each property to your individual heirs. And then at that point, if you have one big commercial property, then you sell that. And then you have one property and you diversify into 4 or 5 different small properties, right? So you have options when you do the exchange, as opposed to stocks and bonds and mutual funds, right? That you can't do. So that's why real estate is a good wealth factor, and because it keeps on deferring and deferring and deferring it all the way down until you pass away.
Right, and then they do the step up for your heirs, and so
Correct.
again they don't have that capital gains either, and then they move forward and do the same thing for their family and go forward from there. Right.
Correct. Right.
You would think in this day and age this would be gone. You know what I mean? Where they want all the tax. And I mean, my statement was how to do this without giving the tax man their money. Well, it's not about that. It's about you want to grow your wealth and not have to pay every time you want to buy something else. Because one of the things that's great about real estate is it's about the leverage, right? So you could have this one property, it grows up in value. You sell that, then you buy 3 other properties with leverage, more leverage, so that you have now 3 properties you can be able to grow for you and invest into. And then those 3 you could sell, sell them and buy 6 or I mean, it's just you can keep building and building without paying that capital gains to other people at this time.
Right. Because if you buy a property all cash, right? So cash on cash return, let's say it's 5%, but as soon as you start to leverage, your cash on cash return goes up because you're using less of your cash and you're leveraging, right? And getting the loan for that. So you might go up 2-3% on your cash on cash return because your yield is going to be higher now. So that's why leverage is a good thing. That's why people use loans to buy real estate, because they're using less of their cash. So same thing with 1031 exchanges. You could do that too, right? So if it goes up in value, you have more equity, you sell, and then you buy 2 properties, and then you split it. Everything gets split up, and then you create more income and basically more appreciation because you got 2 properties working for you instead of 1.
Okay. So now that we got the big tease out there, why we want to do it and how you can save the money and all that, I want to make sure I covered a few different things. All right. So what qualifies as like-kind realty under Section 31? So basically, so you want to explain. So basically, it doesn't have to be the exact same thing. It just has to be like-kind. So you want to explain that?
Sure. Like-kind so the misconception like-kind is like rental house, duplex, commercial. That hasn't been changed in the tax code. It states by the IRS that any property held for the productive use in a trade or business or for investment purposes is considered like kind. And what that means is everything and anything that is investment except your primary residence that you could do a 1031 exchange to and from. And second homes basically fall in no man's land because 90% of the time you never rent it out, right? And you just use it for family use. So those do not qualify because those are personal use. So that's why your, how would you say, investment field has grown to the United States as far as where you can do a 1031 exchange to, and all types of real estate.
That even means land, right?
Land, as long as it's held for investment purposes.
And what would you mean? All right, so if I have a piece of land, I'm buying 500. If I have 50 acres, Tell them hello for us. Five. Say you're buying 50 acres. What does it have to be? Grazing land? Does it have to be, or is it just held as an investment?
Correct. Just held as investment. So that's up to the CPA to make sure they make that designation, right? That it's being held for investment. So it could be grazing land, it could be an orchard, it could be dirt, right? Basically, some people just buy dirt and then they never rent it out, but they hold it for investment purposes.
Right.
So you might
Now,
buy it in what path of growth, right? So, hey, if it's growing, then all these lots are available. You can just pick it up and land bank it, right?
oh wow, didn't think about that. So basically, if you say you bought 32 acres, but you would if you're gonna you have to sell that property in order to buy the 32 acres. You can't have the 32 acres and then change it over and sell like a cabin that was a rental and then pay off the land, right? It'd have to be bought at that time, correct? You follow what I'm asking?
Well, you would have to set up the exchange before any property is closed, right? So
Right.
you have two ways to do the exchange. First way is just straightforward, right? You sell a property, an investment property, to buy the land, right?
Mm-hmm.
So equal to or greater in value, and you could do it that way. The more expensive way is to do it backwards. Okay, that's where hey, I found the land, I want to buy it. You go ahead and buy it, but we got to set up the reverse exchange to buy it, right?
Mm-hmm.
So the IRS puts in guidelines that you can never do an exchange on a property you already own. So therefore, what happens is the exchange company has to take title to one of the properties, either the land that you're buying or the cabin that you're selling. So what has to happen, it determines on if there's going to be a loan. So if there's a loan on the land, the lender's not going to let us hold title to that property as they purchase it. So we have to take title to the cabin. But if you buy all cash, then we step into your shoes at the land, and then we wait for you to sell your property. You have 180 days to sell the cabin to make sure we complete the reverse exchange. So same timelines, but you could do it backwards. Very expensive to do it backwards. So $7,000 to $10,000 to do it backwards. Straightforward, $950.
So we'll do it the right way. Sell it first, find it, we'll go through the whole process of that. So what is not? So real estate not eligible for Section 31. I assume just primary residence. Is that correct?
Or any type of flip property. So flips do not count, right? Because you become a dealer in real estate. That's why your builders and anything held for inventory, right? So builders can't do it. Flips there was no intention to hold, right? The intent to hold is the qualification to the IRS that you held for investment. So that's why fixer-uppers, flips, dealer properties are not being held for investment. They're for what? Resell, inventory. And that's why those other properties do not qualify to do that.
So all right, so I want to make sure we went over a lot already. I have my little list to go through and make sure we cover. So when a gain or loss is recognized, so basically that's only if you do it right, there will be no gain or loss recognized, right?
Exactly. Because when you're doing the 1031 exchange, right, all you're doing is deferring it over. So you haven't realized yet. So you recognize it that, hey, there's a gain, so I'm going to do 1031 exchange. So you just defer it out, right? But if you have a loss, then you got to talk to your CPA, right? That's the number one person you got to be talking to from the get-go. If you have a loss, you might not have to do an exchange, right? You can sell the property and just regroup and then go do another investment.
Right. So basically what I'm hearing is make sure you have a CPA, make sure you have an attorney, make sure you have a lot of people involved when you're actually buying rental properties or land, whatever it is that you're going to use these. So when you go forward, you do it right and don't have a mistake. Right.
Yes. So that's a great point. Is always to what? Have a plan.
Correct.
Right. And that's why you need your team, you need your lender, your realtor, your CPA, financial planner, all on the same boat. Because a lot of times what I hear from the CPAs, oh, they never told me that they were going to sell their property. And then all of a sudden, boom, they go, oh, I got to do an exchange for you. So that's why the CPA say, hey, why don't you contact us first and we can let you know whether or not you should do a 1031 exchange.
Right. I think it's very important to have everybody on the same page, your lender, your agent, everybody, so we know what's going on. It's funny how people just come to us after the fact and say, "This is what I'm doing." Okay, thank you. Or because one of the biggest things we run into is when we have agents who sell people's properties and then want them to go buy another house. They haven't spoken to us to begin with to make sure that they should sell that house because they qualify for another house, right?
Exactly, right? Then you go, oh, so you can't.
No, I don't normally do that, but yeah, we'll figure that out, right? All right, so this is pretty much what you are, right? So what's the role of yourself in the exchange?
So for simplicity, we are a holding company. So for the IRS, that you don't touch the money, right? So
Mhm.
whenever you go online and you do a search, it basically says don't touch the money, and they say don't touch any of the net proceeds. So any cash that you get back, taxed. And then the second thing is any loan that get paid off at the close of escrow, you must obtain a new loan equal to or more, or anything that is not replaced on that debt is considered debt boot. So you got cash boot for the amount of cash that you don't use, and you got debt boot. And that's why we always say when you sell something at 500, you're buying something pretty close to 500 or more to do a fully tax deferred exchange, right? So that's why you always want to make sure that you understand that, because a lot of people just think, oh, on the internet, it just said, just don't touch your money. So I'm not. But what about your debt? That's where Ed, you come in, because you got to get that replacement loan, right? Because they have to get that debt to match equal to or more.
Yeah, because if they don't, then all right. So that was we'll get into one of the other questions I had. Uh, da, 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 I'll jump into that later. But basically, it was about closing costs when you buy. So when you do through the exchange, does the money from the exchange cover closing costs? For the
No,
deal.
not all of them. So IRS has a short list, right, as far as what is qualified costs. So qualified costs are what? Broker fees, title escrow fees, exchange
Right.
fees, anything that's transactional, right, between buyer and seller. However, everything else is basically not going to be considered a qualified cost per the IRS. That's why any loan fees, appraisal fees, taxes, property taxes, insurance, home warranties, those are not closing costs. Those are all associated maybe with the loan or with other types of, how would you say, insurance protection, right? So
Right.
that's why those are not considered a cost. So they're just looking for transactional costs.
All right. Sorry, I was adding. I noticed I didn't have your phone number on there, so I wanted to make sure I had that as a banner for future, so I can let people know how to get a hold of you. All right. So that's your. So what's my next question? What are the time limits?
So
There
this
is a
is
time
the
limit on it.
misconception. Like there's another kind of myth around this where it says, "Hey, as soon as I open up the exchange, that means my time frames start," and that's not true. Your time frames don't start until closing. So the IRS is always about closing dates from property to property, not contract dates. So a lot of people say, "Hey, can I buy and go into contract on my new home construction property now because it's not going to be closed in 6 months, and then sell my property 3 months from now?" Yes, because the IRS says you haven't closed on the new construction property, so therefore it's going to close 6 months from now. You wait to list your property and then you sell it about 3 months before you got to close, because you'll close about 2 months ahead of time and then transfer all the funds to close on your new project. But you went into contract when? 6 months ago. So that's why IRS is always about closing, because you don't own the property yet, right? So it's closing date to closing date. IRS gives you 180 days, approximately 6 months, to do the exchange. The first 45 days is the critical part. This is where you have to identify back to the exchange company your choices of your properties that you wish to buy. And how do you identify them? Basically, are going to be, there's a sheet or a form that we give you once you open up the exchange. And you have, the first rule is 3 properties. You have first choice, second choice, third choice, unlimited value. The IRS doesn't care if it's 10 million, 20 million, 30 million. As long as you can qualify to purchase those properties, you should be fine. And whatever's on your list by the end of the 45th day, which you have to send back to the exchange company, that's what the IRS wants you to buy from. So what happens typically is you're not going to send that list until about day 40 to 45. And then from that list is probably going to be solid because you'll probably have number one in escrow, hopefully in contract, and maybe number two and number three will be your backups. And the second rule is where you want to diversify your portfolio. It's the 200% rule. So if you sold $1 million piece of property, the IRS says you can identify 4 or more properties, but total value of all the properties you identify may not exceed 200% of what you sold or twice the value, right? So I could identify up to $2 million worth of property, and I could do 10 properties, right? As long as they don't exceed $2 million.
And that's the value of them.
The total value of all the properties.
Well, I didn't know there was a limit on it. No, I didn't. I've had you on, and that's the problem out on the radio is you only have 18 minutes. Well, we've been going for 21, and we're not fully through everything I want to talk about. So, you know what I mean? That's the whole purpose. So, all right. So next would be nice. How I have all these questions already set up for you, and I just threw that little softball in there for you so you can answer that. So we talked about when, how, and then the other question is someone asked me, when may the exchanger receive money from the exchange, right? Is that the right
First
word?
off, so once you open the exchange, there's basically only 3 times that you can really get the exchange funds, right? If you don't identify any properties in the 45-day window to identify, IRS says exchange over day 46, and we must close the account, and we have to send the money back, and you just pay your capital gains tax. And then as a California property, we have to do the 3 1/3 withholding of the sales price and send it to the California Franchise Tax Board. The second way is if you identify property and you bought all your identified properties and you have cash left over, then we have to close your account because there's no more properties to buy and you're on day 90. And then we just have to do whatever's left, the cash boot, send 3 1/3 to the California Franchise Tax Board, and then you get the money, you just pay your capital gains tax on that. And the last way is if your 180 days expires and we haven't completed your exchange, and that means you had some properties identified, we have to then close your account out on day 181, do the 3 1/3 withholding, and then send the rest of the money back to you, and you just pay your capital gains tax.
Now, does the state always get that 3 1/3 all the time?
On the boot.
Okay.
So if there's any boot, so if you do a fully tax deferred exchange, then no withholding, right?
Right.
But if you got boot, then there's going to be 3 1/3 withholding.
Okay. And then I already asked this question, about they pay for closing costs, and you went over that. But my biggest, because we've done a few of these where we're a lender and they don't explain everything to you, right? I knew there were certain things that they couldn't pay for through the exchange, but they don't. I mean, having a good exchange company to explain this to everybody is really important, and that's why I have you on. So.
That's why impound accounts too, right? So a lot of people say, hey, I want taxes, insurance impounded, da-da-da. And then what happens is you're going to take net proceeds and drop it in. That is not considered a cost of sale because they're taking money out into a reserve account, right, for that. Mm-hmm. And so that's not considered. They would have to come in with that money, right, to set up the impound accounts to satisfy whatever they want to do. Or they could set it up later after the exchange.
Right. But they'd have to, if they want to set up an impound account, they'd have to bring that money in.
Right.
And then, usually it's easier in the beginning. But then also, if they're paying off, right, a property and they have impounds, a lot of times that impounds, they can either apply it to the principal and pay it down, or they can send it to them as a form of a check.
Well, what they should do is send it to them because that's not even part of the sales transaction because impound accounts is their money, right? So they should wait, close, call the lender, get them impounds, and then send that money over to the new lender and put that money into that impound account.
All right, so let's see here. What's this one? We already talked about dealer being the builders, right?
Well, dealers or flippers, right? So if you're going to do a flip property, that's not going to qualify.
Right. And is there anything they can push tax off with as a dealer? Is there anything they can do? I know.
No, because it's just ordinary income, right?
Right.
So that's why when you do, even though if you do long-term custom spec houses, everybody goes, "Oh, I owned it for like the land for 5 years. Then I build a custom home and I sell it. I don't have to pay. I could do a 1031 exchange." But the IRS said you never held it for investment. You held it for speculation because you were going to do this spec home, this semi-custom, and then resell it. And so that's considered a dealer property, and that won't qualify.
Gotcha. I totally get it now. No, thank you for doing this because I'm learning so much more today. All right. So just so you know, I stole these questions from our radio show that Marlene put together. So bear with me if we go over them again. But what's the what on the screen there? What is the difference between those two exchanges?
So diversification and consolidation exchanges are two ways that help you maneuver your real estate portfolio. So if you want to diversify, right? And you think, hey, this is a great time to sell commercial because commercial is having a little bit of problems, but residential is a hot market. You could sell a larger piece of property, a couple $1 million, right? Sell that and buy smaller properties. So you're going to diversify your portfolio. And you could go where? Anywhere in the United States to buy your other properties. So you're not stuck to one area. You're not localized, okay? So if you got family and friends that are in other areas that you want to kind of eventually go to, then you can spread it out. So that's what diversification. It also helps out with what? Estate planning, right? So a lot of boomers, retirees are using diversification on 1031 exchanges to help them set up their retirements to their heirs. And so we're seeing a lot of that help out family members get properties that they want. So if I have 3 kids and I have my $1 million commercial building, I start saying, hey, I'm going to retire in 10 years. So I start diversifying now, right? Sell it. And I ask each kid, which house do they want me to exchange for them, right? So they know that they're going to get something that they want. And then in my trust, I designate each property to each child. And that's how you do a diversification. Consolidation is when you're kind of growing and you're trying to build a wealth, okay? So when we have the down cycles, right, in the financial crisis, a lot of people bought a lot of real estate very cheap. So what happened is they had maybe 10, 20 homes because they got them for a dime on a dozen, right? So now they're all up in value. They go, they're being tired of being the landlord. So what do? Sell 2 or 3 of them, push them together, and then you start buying what? Small apartments, right? Easier to manage and everything like that. You could go into commercial. You could go into Delaware statutory trust, because if you get tired of being the landlord, then you push them into other avenues of real estate that will still give you that income plus deferred tax shelter on that.
Right. All right. And then let's see if I got it. So normally property has the same tax basis as the one you're getting rid of. Is it possible to increase the appreciation deductions on replaceable property?
Yes, always by buying what? Up.
Oh.
Right? So what happens is if you got a certain cost basis, right? So you buy it for, let's say, 500, then you sell it for 7, right? So your basis was at 5, and then you sell it at 7. So if you want more depreciation, you got to buy up. So you buy from 7 to $1 million, right? That extra 300,000, you add it to your cost basis because that's extra money the IRS looks at. So now you have your cost basis is going to be what? 8, because your gain is only 2. So when you buy the $1 million piece of property, if you turn around and sell it the next day, you should have only your gain that's in there still, the 200,000, right? So now your cost basis has just gone up to 800,000. So now you have more depreciation.
Okay, so there you go. All right, so the next one would be, here's another question that what are build to suit and rehab to suit exchanges?
Those are very sophisticated 1031 exchanges.
See, I'm testing you today. You didn't realize that.
You can do those, and a lot of we have done a lot in Central Valley where you wouldn't even realize that it was a build to suit 1031 exchange, because it's kind of like you want to rehab the property, right? If it has real good structure and bones, but just the inside because everything's going high tech. If it's old tech, right? What you do is you would buy the building all cash, right? And then you would identify the building that you're going to buy, plus the improvements in which you're going to do. And then so what happens is, same thing like the reverse exchange where we have to hold title. IRS says once you own the property, exchange over at whatever value that you get it at. So therefore, on a build to suit, we have to hold title while the improvements are being done with excess exchange funds. And then you identify those. You go ahead and make sure those improvements get done, certain phases. And then once you okay them, then we cut the check from the exchange account to the vendor, whoever you use. So our job is to make sure what? You complete the exchange within 180 days. So that means what? Use all your cash, get your value up to what you need to get it up to, right? Equal to or more than what you sold. Once we complete that, right, is 180 days, we deed the property back to you and the exchange is over, right? However, the project may not be over because you might have odds and ends still go. So you might have to what? Do a takeout construction loan or something to finish the project. And so but you need to finish that project up to what you identified, right? And it has to be pretty close to what you identified. And the IRS uses the 80-20 rule, right? 80% of whatever you identified has to be what that property has to look like. Pretty much similar.
So basically, if you want to do something like this, call you direct.
Yeah, these are very intense,
Okay.
but they have been done. And you know, and that's why when you see signs out there says, "Oh, built to suit," you know, that those are kind of like those build to suit exchanges because they have the plans already set to go, and all you're doing, and there's raw land, right? So you're buying the dirt, and they're going to build it up. So you could go from ground up, and also you could do rehab. Is easier because you already got your structure. All you're doing is having the guys go in and gut the building.
So basically, you're buying land, going to build on it and grow. That's the built to suits. That's an easy example. And the rehab is just you're buying it and you're going to rehab it. Right.
Yep.
Okay. All right.
And those are, you know, like 10 to 11,000 or more.
So I think, yeah, that was built to suit. So here's the next one. Want me to read it out loud, or can you read it on the screen?
So the concept for a conversion of use of property under a 1031 exchange. So number one question, how soon, right, can I move into that property and claim it as my primary residence? Well, first of all, 1031 exchanges are for investment property. Okay, so this is where you need to talk and consult with your tax professional, CPAs, or real estate attorneys to see when is the appropriate time to make the conversion from a 1031 exchange property to a primary residence. So as the tax laws have been changing for the past 20 years, basically the new rule for primary residence section 121 is what? 2 out of the past 5 years, right? To qualify for your 250 as a single person or $500,000 as a married couple filing joint as far as capital gains exclusion, right? And you could do it once every 2 years as long as you haven't done it in the past 2 years. So with 1031 exchange, they changed the law where they said, first of all, if you're going to try to get primary residence tax-free money, there's a minimum holding period of 5 years on the replacement property before you can sell it and live in there, 2 out of the past 5 years. And then January 1st, 2009, they changed the tax code that said anytime that you move into any rental property, right, gain is now going to be prorated from January 1st, 2009 going forward. So therefore, it's going to be a pro rata amount. So you can do the conversion, okay, but on a 1031 exchange property, there's a minimum holding period of that 5 years. So you know you're going to be owning that property for a minimum of 5 years if you want to sell it under the primary residence exclusion. And then the gain gets prorated, and then you apply whenever it was a rental property, you will pay tax, and then the years in which you lived in the property will be allocated to your primary residence exclusion of the 250 or $500,000. It gets very complex. This is where we always say talk to your CPA because they have to do the filing and making sure that you pay capital gains on that portion, and you also get the tax-free on the other portion.
All right. So, and I want to, all right. So this brings up another concept that we've talked about a few times, and I'm going to write in here. make this better. It's not going to be as fancy as the other ones, but second home. All right. So we talked
Yes.
about how to take a. So we haven't talked about on the show yet how to take a 1031 exchange and take it from a property into, and then turn it into a second home. So then that you actually own it as a second home. So you want to explain that?
Sure. So typical feelings of homeowners out there as far as second homes are concerned and vacation homes are basically only personal use, right? They buy that second home for family use, right? For the kids, the other relatives that are basically going to use that for free. However, if you want to do a second home, vacation home 1031 exchange, IRS has come out with guidelines, okay? And so these came out in March of 2008 that now you can do second home, vacation home 1031 exchange. The rule is 2 years before and 2 years after the 1031 exchange, the property has to be an investment property with a minimum requirement of rental as 14 days per 12-month cycle for each of the two 12-month cycles before and after the exchange. So if you have a fully 100% rental, you met that requirement, right?
Mm-hmm.
And they also give you personal use. Personal use is like a 2-week vacation, right? They give you 2 weeks each of the 12-month cycles, either before and after, as personal use. After those time frames, or before those time frames, before the 2 years and after the 2 years, there's no guidelines. So you could either rent it out or not rent it out. You could stay there longer than 2 weeks or not. But they're looking at the time that you do the exchange is very critical, and they want to make sure that it's an investment property that you're selling and an investment property that you're going to be buying and treating as such, like a second home, vacation home. So you could do that. And so that's why the IRS understands that a lot of people, once they do buy a second home, vacation home, it's either going to be eventually only family use eventually, and you can do that.
Do you want to do that though? I mean, my question is, so if you turn it into a second home and then you go to sell it in the future, right? That if you moved into it as a primary, could you get away from with, say that you lived down in the valley and then you decided to move into this full time, and then you later would decided that you're going to sell it because you've been there 5 years and you're just going to move out of state, right? Can you now sell that as a primary residence, or will you still have that 5 year step up period?
Right. You still have that five because it's a 1031 exchange, right? Property. So you got the 5 year hold, right? And then you got to sell it, then the gain is going to be prorated. So remember how the IRS and looks at it is how you sell it, right? If you're in it as an owner occupant, right, then you're under the primary residence ruling. But if it's a rental property at that time, then you have the option to do the 1031 exchange. So that's why they always look at what's the situation at the time of sale, and does it qualify for that?
No, I guess my question wasn't right. My question is, all right, so if you're going to do this 1031 exchange into a second home, right, what is the benefit of doing that? Is it because you can then sell it and not have the capital gains on it later, or you're going to have capital gains because now it's a second home, right? Right. So
basically the benefit of doing the second home, vacation home is like if you have, like, I'll give you an example. So we had people in San Francisco, and then the kids and the grandkids were in Central Valley. And so they go, this is getting too much because we're kind of going back and forth, San Francisco Bay, coming back. So what they did is they bought a second home, in Central Valley, because then that they could use it. But if they did it under the 1031 exchange, they had to make sure it was rented out minimum 14 days per year each year for the first 2 years after the exchange, and their personal use cannot exceed that. So they had to make sure that they had that as a rental first, and then eventually after the 2 years are kind of like up, then they could probably fully use it just personally to keep on visiting the grandkids, and the grandkids have a place to come and do whatever. So that's one benefit. The other benefit is to use, we're seeing that people do it to Florida, to Hawaii, to Arizona, to all these other places where they like to go visit. And so by setting it up, they know when they're not there, it can be rented out very easily. So we had one go to Hawaii. They said, no problem, because people wanted to go to Hawaii to vacation. And so they have friends that always rent it out from them. So as long as you get your minimum requirements in, then you're fine, right? Because you're still classifying that property as an investment property. Eventually, like you said, you can retire here, and then you got your vacation home, second home in Hawaii. You could retire then to Hawaii because that property is there and as a second home, vacation home. So you just do the conversion. You can sell your primary residence here in Central Valley, take your $250,000 or $500,000 exclusion, and then retire to Hawaii. So those are some of the other, I would say, benefits and strategies that I've seen other people use, using the second home, vacation home, 1031 exchange.
All right, so I just want to be clear. So they have that second home. So if they move in there and they live there for 10 years and they go to sell it, is it then it is under a primary residence, or would it still be under a second? You follow me what I'm getting at? I'm just trying to understand the tax benefits of doing that. Would you still have where the value steps up when it turns into a primary residence that from a second home, or do you, and the other question would be, say that you do have a second home, would you sell that under a 1031 exchange if you're going to buy a second home somewhere else and not have capital gains?
Right, but then you got to make sure it's been classified as an investment property first for the first 2 years before you sell. So you got to make sure you rent it, right? And then do it. So what your question was about, hey, afterwards, right? You'll still get a prorated amount, right? So if you live there for 10 years, you say, hey, I'm going to sell it. But you got to remember, when the second home, vacation home, when you did a tender exchange, the first 2 years had to be rental, right? You got to qualify for that property for that. So what's going to happen is you're going to pay the taxes for those 2-3 years initially in the beginning, but the other 10 years is going to be allocated to your primary residence exclusion. So is it 100% good? No. But is it almost good? Yeah, it's better than not paying 100% of the taxes, right?
Gotcha.
So you might get like 80% of the gain tax-free or 70% of tax-free, but you still have to pay something in capital gain. It's not 100% like it was before.
Right. So talk to your CPA, basically.
Right.
All right. So, we already see. I'm going to jump ahead. We already talked about this one, which was reverse stock. That's the reverse where you get involved after the fact. You bought the property already. Can an operating business be exchanged under Section 31?
Businesses cannot do 1031 exchange under the tax reform under the Trump administration. 1031 exchanges got cut in half. No more businesses can do 1031 exchanges, only real estate. The reason being because they gave you the 100% write-off of all your assets, right, that you're going to be operating for your business in the year in which you buy it. So they already gave you, they said, a big chunk. So no more, you don't have to do a 1031 exchange on it anymore. So, but you could buy a real estate property for the production use in a trade or business. So if you have a business, let's say I'm a baker, and then I want to buy a building that I'm going to bake and sell these things, I could actually go do a tender exchange from a rental house to a commercial building that I'm going to run my business out of. And then I can operate it out of there. So you could do that.
Right, but then that would still be owned by you, not the business, right?
Correct. Right.
So that's basically business. No, we'll just leave it at that. Right.
But that's the way to use the 1031 exchange to help you kind of, I would say, expand your business or operate your business in your own property, right?
Right. Now, seller financing doesn't really affect 1031 exchange, right?
Yes and no. When you list the property and you're selling, if you're the seller and you're doing the 1031 exchange, this is kind of like you don't want to do a seller carryback, because what happens is when you have to take back a note and you want it part of the exchange and you want to do 100% exchange, you have to buy the note at face value out of the exchange. So if you got a $100,000 note, you got to go find $100,000 cash somewhere, bring it back into the exchange, buy the note out, and then we assign the note to them. And then now you have all the cash to do the tender exchange. However, on the flip side, when you are buying the property and you have, let's say, a loan that got paid off, right?
Mm-hmm.
So you sold it for 500, you had a $100,000 loan, and then now you got 400 cash. So you put 400 down. You can ask the seller to say, hey, would you be willing to carry a $100,000 note? And if they say yes, then that satisfies your note requirement, right? So you still bought a $500,000, 400 down, and the seller did a $100,000 seller carryback, and that satisfies the debt requirement. So that's why it's good when you buy, not good when you sell.
Right. So basically, if you're selling, don't carry a note. But when you're buying, go ahead to sell. It doesn't matter if it's seller, bank, or whatever financing. Right?
Yep, you can do it cash. That's why there's 5 ways to satisfy the debt requirement, right?
Right.
New loan, that's the obvious. Pay out cash. Seller could do seller carryback. You can assume or do a subject to existing finance.
Yeah. A lot of people don't understand the assume and all the other stuff.
It's called FHA.
Well, no, it's just been too long since people have had to do that because where rates are so low now, it makes more sense to do it now than to assume some of the older notes, right? So, all right. So, what happens when the owner or partnerships or can an LLC do an exchange? Actually,
Yes, corporations could do it, partnerships could do it, and that's why we're always looking to see who is selling the property, right?
right.
So whatever entity, is it an individual? Is it an LLC? Is it a trust? And typically, if it's a husband and wife LLC, is it considered a disregarded entity, right? Because as long as it's them as husband and wife or a single member. And if it's a trust, living trust, IRS looks at that as a disregarded entity too, because typically everything flows into them as the tax returns because they're using for probate purposes. And if it's husband and wife, it's for more asset protection. But once you go multi-member, so if you and I, Ed, set up and buy a property and we set up an LLC, we're basically a multi-member LLC, right? 2 different parties, 2 different tax-paying entities. Once you have that, and then we set up the LLC, then the LLC has to do the exchange. And there's no way for us to split because we have Ed and Jeff LLC. That's the entity that owns the property. Therefore, that entity has to buy and do the 1031 exchange. Now, if we wanted to split, we would have had to set it up differently. We would have to set it up Ed LLC, 50% owner, Jeff LLC, 50% owner. Now, we could sell that property and do it together still, or what? We could split, right? Because we are 2 separate entities on that property. And that's the like partnerships. Everybody goes, oh, great, it's a partnership, right? And so everybody buys into it. All 10 people get in. And now 2 or 3 people say, hey, we want out. Let's sell the property. They can't, right? Because now you're stuck. So the people that want to continue on and invest in real estate, they're going to have to wait. And the people that want out, they're going to have to wait too because they got to dissolve the partnership. And so the ones that don't want to do it anymore could get out, right? And then they got to regroup the other group and put it all back together. So it's very cumbersome. So whenever you have a group that wants to get together, understand what's the exit strategy. Always look at the end before you put everything together in the front.
So basically, before you get in, you always got to look for the exit, no matter what. It's the same way with your business. Growing a business, you have to see what's my long term. How do I get out of the business and sell it? What's my plan? So same
Exactly.
here. Yeah. And what a lot of people don't realize, partnerships is like marriage. You guys don't always get along, but you're stuck together until there's a divorce or. And I don't mean that wrong, but basically, if I want to sell something and you don't want to sell it, it's a no. So, yeah.
Right. And see, that's why if you have, even though you want the asset protection, we got Ed LLC, Jeff LLC. If somebody wants to buy you out, Ed, and you say, hey, I'm going to sell it to so-and-so, you could sell your 50% and the other person just plops in, right?
Right.
And so that's why it makes it so easier how do you structure your, how we say, partnership, right? If it's
right. Because I can see why it's so important to have your own LLC if you're going to go in business with another person to buy property, so that you both, if you've done, one can go, okay, I'll buy you out. You can go forward, or I'm going to do this exchange, whatever. When you're together in it, it's a little bit more complicated, and I can see that. So, all right, just 2 more questions, and then there's anything. Now, No, so there's any alternative to the 1031 exchange for LLCs or partnerships?
Not really. They would have to
Yeah.
dissolve it, right? They got to dissolve the LLC or partnership, and they would have to hold it as individuals, and then they would have to sell it, and then do an exchange for the ones that want to do it, and then pay the taxes for the other ones that don't want to reinvest.
Now, say you bought a piece of property as within your LLC, and you're the one member LLC. It's yours, and you just, because a lot of times we run into, when we do loans, in order to do the right, conventional, those type of loans, it can't be in the name of LLC sometimes. Does it affect the tax if you take it out of the LLC and put it back in the individual's name, and then after the close put it back in the LLC? Does it affect any of that tax?
So if it's a disregarded entity, meaning it passes through right into their tax returns because they're just doing it for asset protection.
Mm-hmm.
So that's where you got to go back and talk to the CPA. Then what happens is they don't have to pull it out, right? So what you could do is just on the 1031 exchange is basically put the loan into the individual name. They'll take title as an individual, and then after the close of escrow, then they just go ahead and put it back into the LLC, right? Mm-hmm. And won't affect the exchange. But if it's a separate tax-paying entity, right, that they set up, and then what happens is you guys probably won't be able to even loan to it because it's LLC.
Right. We have situations where there's certain people that will loan to them. It's just better if it's an individual.
Typically individuals are pass-through entities.
Right. Yeah. Most people set them up just to protect themselves property-wise,
mm-hmm.
all their rentals
mm-hmm.
and stuff. Can a charitable remainder trust be used as an alternative?
Yes. And so that's where if you want to be very charitable, right? Because basically once you pass, it doesn't go to your heirs, it goes to the charity that's going to be named as the remainder. So that's why you have to be very careful that if that's what you choose to do, that you go ahead and set that up. But that is an alternative exit strategy.
Right. Now, when we started this, I was talking about a client who called me and said they were done with, having their houses, right, and they were going to sell everything. And we talked about this on the radio show at first, where we were talking about what can you invest in other than actual property, land, that kind of stuff. And you brought up a couple different things like a REIT and then something else. So you want to quickly explain that, what I'm talking about?
Sure.
If you don't want to deal with tenants anymore, you don't want to deal with people or cows or whatever you have on these properties, you know what I mean? Because you can buy a lot of different things with a 1031 exchange. So what if you're done with that and you want to put your money in something else? What can you do?
Sure. So if you're tired of the tenants and toilets and trash and all those cows and animals, so what you can do is not a REIT. Okay, a REIT is considered a 721 REIT, and basically you're going from real estate to personal property, which is stocks and a stock holding, right, into a REIT. Right. That is not a 1031 exchange. That's called a 721, and you got to talk to your financial person. But that means what? Once you sell your stocks and you want to come back into real estate, you're going to get taxed, right? With a 1031 exchange, there is something called a Delaware statutory trust. These types of properties are institutional grade properties that you can buy a fractional interest of that property by reinvesting into it either via 1031 exchange or a direct placement into the project. They are basically a certain amount of properties. They look like a REIT because they're institutional grade. So there might be Amazon Fulfillment Center, a Walgreens, student housing projects, apartments, or 200 plus apartments. These are the types of properties that are going to be in these DSTs. And you would buy a fractional interest, and basically it's 100% passive, meaning that you have no control. All you do is sit back, collect the rent, and then file your tax returns. That's all you do. Because once they say you're in, they're looking for your investment, right? They want your money, and then they're going to handle everything. So these properties are already up and running. You have to be an accredited investor, meaning $1 million net worth or more, excluding your primary residence, and that's all your estate, right, at that time. And then you have to be bought through a financial security licensed persons, because first, these are governed by the Securities and Exchange Commission because they're private placement, meaning that they're off market. Okay, they're only for the accreditation people that qualify. Number two, it qualifies for 1031 exchange replacement properties. So you could sell your properties that you had in California, right, and you want to get out. Then you could put these into these types of institutional grade properties, and all you could do is say, hey, I'm done with being a landlord. Now I just want to sit back and start collecting rent, but I still don't want to pay any taxes. This is one of the alternatives that are out there for investors in real estate that can help still keep their wealth and still get that income flow without paying the capital gains tax. These things are also asset protection, meaning that you're buying in the trust, right? So the trust is the one that is protecting the individuals. And so the trust is on the hook, or the sponsor that brings these properties to market. And so, and also they're probate protected too. So if somebody passes away, then their share, right, goes to the heirs. So they're not going to liquidate the property. What they do is they just pay the heirs or the estate the income flow until once they sell, then they give the pro rata amount of equity and appreciation to the estate, and then let the heirs deal with it from that point. So these are good if you kind of like Ed was saying, you're done. I'm done with the animals, the chickens, the cows, and the turkeys, and the toilets and the tenants and the trash. I'm out of here. I just want to sit back, relax, and enjoy. That is a good alternative. But you know,
what was
here again,
Delaware what?
Statutory trusts. They're called DST properties. And then you have to buy them from a securitized licensed securities rep. And there's only a handful, I would say, throughout California, as opposed to real estate agents. And then,
So is this right?
yes.
Okay. Yeah, I just want to make sure we had that up there so somebody, was wanting to know, because you said it, and I don't know if I spelled statutory right, but oh well. That's what you get. Go ahead. I'm sorry for interrupting.
No, and I think that's a good excess strategy, because even if you have, let's say you're doing a regular exchange, right? You sell $1 million piece of property, but you only find $750,000 replacement property. Now you got $250,000 boot, right? Either cash or debt that you gotta still do. The Delaware Statutory Trust is kind of like, oh, can I just throw $250 at it? Yep. Just take whatever's remainder, put it into there. Now you got 100%, right? 1031 exchange, and you didn't pay any taxes, and you're still going to generate income on that $250 that you would have had to pay taxes on.
Yeah, one of my neighbors next door, he was, when they were thinking about selling all their rentals, and this is not the caller, this is a different, and doing the same thing. He was like, they'll pay me, I just put the money in there and I get money and I don't have to deal with anybody. I'm like, and he's like, and it still goes up in value, it still does this. And so for a lot of people, I think, who are, because I mean, right now, if you have a rental property, you can sell it all day long and then turn it into a primary residence for somebody, because we're short on properties right now. And then eventually, as they build more properties, sometime in some future, you could always get back in and sell this and get back into that. So
yeah, and that's a good thing about the Delaware Statutory Trust. When they sell, I come back to you, Ed, and say, hey, is the market right for me to come back? And if you say yes, because I'm the Delaware Statutory Trust signal that they're selling, right? They typically tell you about 6 months in advance they're selling. So I'm coming back to you, Ed, and said, hey, Ed, hey, is Modesto ready? Can I come back? And if you say yeah, then once I get sold, then I'm going to do an exchange into the local market, right? Mm-hmm. So that's why with the Delaware Statutory, you have that option to come back into the market. And if you say no, I would just say, okay, right back into another Delaware Statutory Trust. I will exchange back into another one. And then it's going to come back out about 5 years. And then I'll ask you again, 5 years later, is the market ready? And then I'll go ahead and do a tender exchange back into the market.
Gotcha. All right. So anything else we need to add that I missed? Did I spell your name right? Yeah, I got it right. Is that right? And the phone number? It's 916-612-1031?
Yes, that is good.
All right. So
if you have any questions, feel free to give us a call. We're more than happy to discuss it.
I mean, because this is very involved. 1031 exchanges. People don't think about it. They think about it after the fact, sometimes too late. And I try to explain to everybody, if you're going to sell an investment property, before you do anything, talk to somebody and get the right information so that you can be taken care of and you don't pay taxes when you don't need to. We pay enough taxes as it is, and from what I'm hearing going forward, we're going to pay a lot more. So let's make sure that we save as much as we can. Jeff, I want to thank you so much for coming on today and explaining this, and taking an hour of your time to go more in depth about what 1031 exchanges. And if again, this is the extension of Real Estate Jerky Radio, and then we're here Tuesdays and Thursdays at 11 a.m. So again, Jeff, thank you so much for being here today.
Oh, thank you very much, Ed. We appreciate it too.
All right, stay right there. And for everybody else, see you on Thursday.